Hello everybody. Today we'll be talking about the prescribed format for the balance sheet for profit-making business entities. You'll see that we need to start with a title. The prescribed title is shown here. So rather than just writing balance sheets, we need to write the statement of financial position for the business name and also include the date, the reporting date that is. So we start off by putting in non-current assets, sometimes referred to as fixed assets. So these are items of monetary value that the business owns, not intended for resale and to be used to generate revenue for the business. So in this example, the hypothetical business has $200 million worth of non-current assets. Depreciation is the loss in value of these non-current assets due to wear and tear. So in this particular example, the business has lost $20 million in terms of depreciation on its fixed assets. So the total value of our net current assets is 200 minus 20, so it's 180 million. Moving on, the next thing to report is the firm's current assets. So these are items that the business owns of monetary value that it intends to turn into cash or is cash within the next 12 months of the balance sheet date. So in this case, we have cash of 15 million, debtors of 25 million. These are businesses or individuals that owe us money and they've bought items from us on trade credit. So they're expected to pay those back usually between 30 to 60 days. And stock is inventory. So in this particular case, the business has $20 million worth of inventory. So if we add all those liquid assets together, the total value of our current assets is 60 million. So putting that all together, we have $180 million worth of non-current assets plus our $60 million worth of current assets. So the firm's total assets equal 240 million. Then comes the firm's liabilities. This is money that the business owes for the debt it has accrued. One category of liabilities is current liabilities. These are due within 12 months of the balance sheet date. So in this particular case, the business has $5 million of bank overdrafts, $20 million worth of trade creditors, and $15 million of other short-term loans. These are all due within 12 months of the balance sheet date. So the firm's total value of current liabilities in this case adds up to 40 million. So what about its long-term debts? So these are called non-current liabilities. So they are debts owed by the business due after 12 months of the balance sheet date, such as a mortgage. So in this case, our firm has borrowings of $100 million. So its non-current liabilities total 100 million in this case. So putting all that together, the firm has current liabilities of 40 million and $100 million of non-current liabilities. So its total debts are 140 million. So when we put the balance sheet together, we can see the total assets, 240 million, take away the total liabilities, means that the firm has net assets, overall assets, worth $100 million. Equity is what belongs to the owners of the business. So for a company owned by shareholders, in this particular case, the business has $80 million worth of share capital and $20 million worth of retained earnings, which is profit from previous years. So its total equity, the total value of the business that belongs to the shareholders, is 100 million. Now I've put an asterisk here just to remind us that if we're creating a balance sheet for sole traders, partnerships or non-profit organisations, they do not have share capital, so we would not include this value for those business entities. So putting the balance sheet together, our net assets we mentioned earlier on were 100 million and our equity is also 100 million, hence the balance sheet balances. Hopefully that's given you a brief overview of why the balance sheet balances using the figures that we've got here. Please review the video because this is quite a tricky topic, so you want to make sure you understand how the balance sheet is constructed and why it balances in the way it does. That's all for now. Bye bye.